Over the last 8 months, gold enjoyed a meteoric rise in price of more than 50%. However, on the last day of January 2026, it suffered a one-day 11% fall. Silver was even more extreme, tripling in value before losing 30% on the same day. How's it, everyone? My name is Bruno and I manage alternative investments for fund managers and for advisors. I also spend a good deal of my time studying how the world's largest trend-following funds work. And in this video, I'm going to share with you how they behaved in the run-up as well as during January's precious metals mayhem. This video is a case study that gives you 3 clear and practical takeaways to better understand how trend-following funds work, because I think that they're a premier diversifier for the core equity and bond portfolio you likely already have. So let's start with silver's performance first. What I've got is a graph showing silver's performance from January 2021 all the way through to February of 2026. And what we find is that silver has bobbed up and down, but really gone sideways for that entire period. And because trend following is a strategy that goes long rising markets, short falling markets, and profits from a continuation in those trends, you'd expect that trend followers got long at various stages only to experience a false start. In other words, a trend that didn't go anywhere and therefore suffered small but tolerable losses over the years. However, in the latest episode from roughly June 2025, so that's roughly speaking 8 months ago, trend followers got long silver and benefited from a 235% rise in price, before that 31% or so one-day crash that I spoke about in the introduction. This is exactly what a trend-following strategy is designed to do. It's designed to hunt outliers just like silver has been over the past few months. Trend-following funds don't predict moves, they just simply respond to price behavior. So they would have gotten long many times over the period from 2021 through 2025. It just so happens that silver on this occasion had an outsized return that trend followers mostly participated in. Next, let's have a look at gold's performance over the same period. So gold also bounced up and down from the period 2021 to roughly January of 2024. So trend followers would likely have been long gold way before they were long silver. However, over the same period that silver tripled in value, gold also experienced a fantastic return of about 56% before its 11% one-day crash at the end of January. Nevertheless, applying a trend-following strategy to participating in gold would have had an excellent result over the last few months, allowing you to ride this entire wave up, or at least the majority of it. So now that we've got the context, how did trend-following funds capture gold and silver's outsized returns? The answer is really well. What you're looking at here is a graph of the cumulative returns of the SocGen Trend Index from 1 June 2025 until the end of January 2026. The SocGen Trend Index is a peer group average of the largest 10 trend-following funds in the world by assets under management that are also open to new investment. And they rose by 23.7% all the way through to the 29th of January and only fell 2.2% on the last day where gold and silver experienced that horrible crash. So in a month where you had a really tough crash, the trend index was still up 4.7%. But how can I be so sure that trend investors actually participated in gold and silver returns? It's not like the SG Trend Index publishes their daily holdings. But that's where my friend and yours, the good old-fashioned regression, comes in. So what I did was run a robust regression for every day throughout the sample of the likely set of exposures among global equities, bonds, currencies, and commodities that best explain the SG index's performance over the preceding days. And the results of my regression looked like this. So you've still got the SG Trend Index's performance in blue, and my result in red, which is to say the sets of exposures that I estimated the SocGen Trend Index to have held produced the red line over time. It's a pretty good fit. My replicating portfolio produced 20% over the period, which was slightly less than the SocGen's index was. And for those of you who like this sort of thing, I've got the regression output over here as well. What I find is that gold contributed 4.9% of the replicating portfolio's returns over the period, and silver contributed 3.5%. So all in all, out of the full 20% performance, the combination of precious metals produced 43% of those returns. So what this regression gives me is confidence that I understand the key drivers of performance over this period for trend returns. What that allows me to do is to zoom into any single market's positioning over this period. Of course, we're mostly interested in gold and silver for the purposes of this video, so let's have a look at that now. This graph shows two things. My estimate of gold positioning over the period 1 June 2025 to the end of January 2026, starting roughly at 10% at the beginning of the period, ending at about 12 or 13% at the end, with big oscillations in between. And then secondly, on the right axis, just gold returns over this period as covered by this blue area chart. Two things to note specifically. First and foremost, trend followers have been long gold throughout this period, we know that. But what we find is that during this first phase of positive price performance for gold, trend followers increase their position almost fourfold, actually fivefold, from around 5% all the way through to 22-23% at its peak. What we then find is, even though gold continued to perform after peak gold exposure, trend followers actually started to reduce their positioning into gold strength. And if we have a look at the second phase of outperformance, the really significant January performance, we see a similar type of thing. So gold was rising in value quite steadily from the period November to December 2025, and so too gold positioning rose with it. However, as soon as volatility started to spike, volatility is this thing that we think of as only materializing on the downside, but you absolutely get upside volatility as well. But as soon as gold returns started to become overextended, extreme even, and volatility started to rise with it, we see this tendency for trend followers to actually reduce their position in a highly trending asset. So that's pretty interesting. If we take a second to understand whether that behavior is consistent with silver as well, we actually find much of the same thing. So over here, I've got silver positioning on the left axis, starting at around 2%, ending at roughly the same number, oscillating quite severely in between. And on the right axis, just silver returns over time. That's on a log scale because silver returns have been quite extreme. So although this initial jump doesn't look that impressive, in hindsight, it absolutely was when you were living it. And we find a similar kind of thing. When you have this semi-well-behaved silver upward performance over the period August to October 2025, you have exposure rising with this strong trend. However, peak exposure comes right before volatility starts to surge and trend followers deem the move overextended. So for risk management purposes, they actually start to reduce their positioning into a strong market, as we see during that first phase. Then during the second phase of performance, the really overextended extreme performance that we've seen of late, we see this behavior once more. A small rise in silver exposure initially, so as soon as volatility starts to surge and moves become extended, trend followers actually tend to reduce their positioning into a very strong trending market. So let's see if we can better expand on the explanation behind this counterintuitive behavior where trend followers actively reduce their positioning as trends strengthen. The first is the most obvious. Trend strategies actively rebalance. This is clear and obvious because otherwise we would just see positioning rise and rise and rise as trends rose and rose and rose. And what we see is the opposite. So what trend followers are not doing is buying a position of say 10% and allowing that position to freely rise. So otherwise we would see 10% becoming 15, 20, 25, and that's clearly not what we observe. The second point is pretty important. It's that trend strategies tend to size positions relative to risk or volatility specifically. This is a big leap of logic to make as soon as you start to move away from the long-only world to the hedge fund world. Generally speaking, trend followers think of allocating units of risk to different markets as opposed to dollar allocation to different markets. Which is to say, we are pretty confident that trend followers target and actively rebalance to a fixed target of volatility over time. We see this because trend fund volatility over any reasonable look-back period tends to bounce around between the 10 to 20% range, averaging something like 13% over time. So if we're looking for consistency across our portfolio in terms of allocating to different markets of varying risk, what we need to do is to allocate less to very volatile markets, and that's what we see in terms of trend following behavior over this period. And finally, trend followers likely cap positions as moves become extreme. A good way to illustrate this is using this graph over here. So on the initial parts of a strong upward move, trend followers likely increase their position as a function of that move strength. However, once moves become overextended, position size, as illustrated over here by the y-axis, actually starts to become concave and eventually tail off. The same can be said on short positions. The beginnings of a move are fuel to increase exposure. However, once a move becomes overextended, we become less willing to allocate more and more. An extreme version of this is shown by way of this graph over here, where as a move becomes more and more extreme, you actually start to reduce your exposure all the way through to a flat position. And so on the left-hand side, you cap positions as trends overextend, and on the right-hand side, you reduce your position as trends overextend. So in summary, trend strategies actively rebalance, they size positions using volatility, and they cap positions as moves become extreme, which are all consistent with what we saw trend followers do in terms of their gold and silver positions over the past 8 months. At the start of this video, I noted that a lot of investors try to participate in the wild moves in gold and silver over the past few months, and unfortunately many got burned. What I hope this video has demonstrated is that trend following offers a compelling approach to participating in these wild outlier events in a safe manner. Trend following is, above all else, outlier hunting. It is built to find and to participate in moves like those that have gone on in both gold and silver over the past few months. And the key is that the strategy doesn't know when those moves are going to happen, nor does it predict when the moves are going to end. It's simply a disciplined process to participate in these outlier events. And what I hope this has demonstrated to you is that trend following is a really compelling strategy to consider alongside your core equity and bond portfolio, because it offers a highly differentiated and attractive return stream over time. Well, that's it from me today. I hope you enjoyed that video. If you did, please consider subscribing. This channel is going to be all about me sharing what I know about my favorite alternative strategy and how they pair well with the equity and bond portfolio you likely already have. If that's something you're interested in, please consider coming along for the ride.